Hello and welcome to the Owner Finance Academy, where we help Canadians build wealth by buying U.S. real estate and selling with owner financing. Before we begin, a quick reminder that everything shared on this channel is for educational purposes only. Every situation is different, so always consult qualified legal, tax, accounting, and financial professionals before making investment decisions. People often ask, why invest in the U.S. instead of buying rental properties here in Canada? Well, firstly, as you know, the slow flip strategy does not teach buying rentals. This is an owner financing play where we buy on terms and sell on terms. But there are four main reasons why I opted to do this strategy in the US instead of Canada. And truth be told, most of those reasons are all related to the same issue, the matter of affordability. So that'll be reason number one. In the US, you can have a lower purchase price in many US markets. Lower purchase price means you, as the investor, need less money to get started. Let's talk real numbers. In the US, you can find a property for $25,000, $35,000, $45,000. I'm not speaking about a garage or a shack. I mean a fully functional home with a working toilet, working kitchen, living room, 1, 2, 3, sometimes even 4 or 5 bedrooms, depending where you are. So the ability to buy a property for that price opens up a world of possibilities for you as a Canadian investor. Now, truth is that you will have to spend more Canadian dollars to get that US property. But I've run the math, and many other investors have too. And I can tell you that you will still come out ahead just because you can buy more properties and leading to number two, generate more cash flow. Now, in order to talk about this, you have to remember what the slow flip strategy is all about. So let's do a quick rundown. In the slow flip strategy, you as the investor are spending 40, 50, maybe sometimes even 25 or 30,000 buying a property. You are buying this property using short-term financing. So whether you use your own equity line of credit or you use a credit line or some financing or even your own money, the plan is to buy this property and be on the hook for repayment for a very short period of time, usually 5 to 7 years. So you are buying the property for 30, 40, or 50,000 US. Maybe you borrowed for it and you are repaying that loan for, say, 5 to 7 years. But after the 5 to 7 years, you still want to receive money. And so in order to do that, you're going to sell the property right as soon as you buy it. You will sell it to an occupant and put that occupant on a 30-year mortgage in the US, which is the standard amortization period. So that means they will pay you not only for the first 5 to 7 years, and you'll use their money to repay back your loan, they will continue to pay you for the remaining 25 to 30 years. That's where the cash flow play really comes. And that model is difficult to enact here in Canada because it is difficult to find a property that you could afford to pay 5 to 7 years into a mortgage and then turn around and sell that as well for 30 years, right at the same time as you're buying it for that period of time. So it's a very difficult math to make work. And the reason it's hard is because your monthly payment to your lender has to match more or less what a Canadian person would be willing to pay for rent. And if you do the math, it just doesn't work out. If you buy a property for $300,000, amortize it over 5 to 7 years, your loan payment ends up being much larger than any Canadian would be willing to pay as a monthly rent. But in the US, that math actually does work. If you buy something for $30,000, $40,000, and your payment to your lender is in the range of $600, $700, $800 a month, it is quite viable that you can find a market where the renters will also be paying $600, $700, $800, $900, $1,000 a month. And so that works very well for you. And once you pay back your own loan, then you are in the money. The cash flow really kicks in because you have relatively low expenses after you've paid over your mortgage. All right, so let's review the two reasons I mentioned so far. Reason number one, things are more affordable. You can find low price homes that are still suitable for occupants to live in. As a result, point number two, you have a greater opportunity for cash flow, because after you pay your initial loan, your 5 to 7 year loan, then you're still collecting payments from the renter, or in this case, the buyer, we should call them, occupant buyer, for the next 25 to 30 years. So that means reason number three, you can scale. You can scale your portfolio, right? The lower acquisition costs means you can buy more properties. Whereas in Canada, with the same amount of money, say $60,000, perhaps you could put a down payment on one property. In the US, you can buy 2, 3, 4 properties by spending $60,000 at a time. And by doing that, you can recycle your money and then go and do it again, because every 5 to 7 years, you've paid off your original loan from your original lender. They are willing to lend to you again, so you can go back and repeat the process over and over again. In fact, those who are more aggressive will go out and get way more than just one lender, way more than one loan. They can scale up this strategy quite a bit. And then lastly, look, it is just a better fit for the slow flip strategy, because there are many markets in the US where this instrument, the legal instrument used for the slow flip strategy, is actually there in their policies by design. So you'll hear terms like contract for deed, land contract, agreement for deed. These are all instruments that have been created specifically for this method of buying, where an occupant will buy a property on terms and they are essentially being financed by the seller. And this is current way that people buy, and in fact it's created in part to give people who wouldn't otherwise have the opportunity to buy a property to be able to do so, and keeping their payments affordable. All right, so you've heard it here. These are the main reasons for using the slow flip strategy in the US versus in Canada. It is just much more doable down there. Now, that is not to say that investing in real estate in Canada is a bad idea. In fact, we even have a course on this that you can find on Udemy that teaches how to invest remotely in properties in Canada. So very much a viable investment strategy. The US strategy specifically for slow flip is just an interesting one if you're looking for cash flow and you're looking to get into the market with a lower purchase price and something that's repeatable and can scale. Well, I hope you found this lesson helpful. If you'd like to learn the Owner Finance Academy system for Canadians investing remotely in US real estate, you'll find a link in the description. If you're not quite ready for the full course, or you'd simply like a practical tool to get started, you can download the Slow Flip Viability Diagnostic. It'll help you evaluate whether the property you're looking at right now is a good fit. And then you'll also find an application to get into the cohort. This is a free cohort where you'll be part of a group of Canadians learning the slow flip investment strategy together and getting help to buy their first US property. You can apply by clicking on the link in the description. Thank you very much. We'll see you in the next lesson.